Good morning and welcome to Stock Market Today. It's Monday, September 9th, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email to follow along with this show, as well as get daily stock ideas for you to consider. Hits your inbox every trading day before the market opens. So major U.S. equity indices were mixed in Friday's trading, ending off their best levels of the day. Stocks did rally for a second consecutive week after 4 weeks of declines. Treasuries were stronger across the curve after a big jump in bond yields on Thursday. The dollar was little changed against the euro and the yen. Gold finished down 70 basis points, and WTI crude settled up 40 basis points, reversing earlier declines. Your outperforming sectors were energy, materials, and consumer staples. Your underperformers were utilities, comm services, and tech. As we get to the desk this morning, futures are up 30 basis points to begin the new week. Asian markets were mostly higher overnight, with China outperforming. European equities are mostly higher, though the upside is limited across the pond. Treasuries are under pressure across the curve following last week's back up in yields. The dollar is slightly stronger against the yen and slightly weaker against the euro. Gold is up 10 basis points, and WTI crude is up 90 basis points to begin the new week. As we look at the S&P 500 and the structure of trading right now, we have held above the breakout level, and that was following the weaker than expected August payroll report that was released Friday morning prior to trading. We are now moving our support level up to the 2,900 to 2,950 zone. Resistance is in the area between 3,000 round number area, and the July highs up around 30.30. The RSI is moving higher with price, and that is an encouraging sign as it begins to lend a bit of a momentum confirmation to the strength in price, especially as price breaks out of a consolidation range. Chaikin money flow as well is bullish. So the indicators are starting to get into gear. The index is holding above the breakout level. So now what we want to look for is obviously a hold above this 2950 area, although we will acknowledge that 2900 to 2950 is a more realistic support zone. And on any pullbacks, we want to see the RSI hold above 40. Ideally, we would love to see it hold above 50, but if it holds above 40, that would be considered holding within bullish ranges, and we would look for it to continue to confirm price strength as the market moves higher. As well, we want to see Chaikin money flow remain on a bullish reading. So we've been highlighting for a while everything we've been looking for, and at the same time, we've been saying continue to focus on bullish ideas in the leading areas of the market. And that strategy at this time does not change, with the market holding above support and holding above a rising 200-day moving average. Diving in now to our market in a minute. What are we writing about in our note to Chaikin Analytics clients today? First, we just touched on it, the S&P 500 holding the breakout from the August trading range. The August payroll report missed expectations, and Chairman Powell spoke on Friday, and we didn't really hear anything to change the market's view as it relates to a rate cut here in September. Market continues to see a 25 basis point cut at the September meeting. Energy remains a lagging sector, and as we said, futures do point to a higher open here today, following through a bit on the breakout towards the tail end of last week. As we take a look now at the power bars for the major indices, we can see continued shift to the bullish side for the power bars. The Dow added 24 basis points, power bar ratio 6 bulls to 5 bears. S&P 500 relatively flat, 115 bulls, 81 bears. NASDAQ underperformer, down 10 basis points on the day, but that power bar ratio holds bullish rather. 26 bullish or very bullish stocks there, 17 bearish or very bearish stocks. Small caps just continue to underperform even as the market acts well. Power bar ratio is trying for us, 422 bulls, 362 bears, but the group did underperform again on Friday. After a big decline on Thursday, bonds rallied on Friday, up 71 basis points to send yields lower. We talk about bonds a little bit later in the show. According to the Chaikin Power Bar, small cap stocks and large cap stocks are somewhat bullish. Major indexes are all bullish for the power bar ratio. Let's take a look at our stock of the day now. Hub Group And transportation industry group. Hub Group, ticker symbol HUBG, closed at 43.68, down 21 basis points on Friday. Chaikin Power Gauge rating for Hub Group is very bullish due to very attractive financial metrics and strong earnings performance. When we take into account the 20 factors, 5 in each of these 4 categories, we come out with a very bullish Chaikin Power Gauge rating. And then we see we have a strong trend and a strong industry group. And let's take a look now. Market and model getting into gear. That very bullish rating is now being met with a shift in relative strength. Notice how it was an intense underperformer through June and July, and the intensity of underperformance began to dampen or lessen through the month of August. And now as we move into September, we're actually a slight outperformer. Not enough there yet to get me excited, especially when we consider Chaikin money flow is still bearish and the stock is overbought. You can see here, the analysis is mixed, and that kind of lines up with this choppy trading range that we are seeing for Hub Group. So what does that mean? We're going to add Hub Group to a bullish watch list and continue to monitor it for opportunity should they present itself. So all else being equal, what we want to see is, obviously we want to see money flow improve. We want to see continued outperformance, and we want to try to find the stock when it is oversold, not when it is overbought. So add Hub Group HUBG to a bullish watch list, but I don't see any real reason to get involved on the long side here today. Taking a look at our sector tracker now, the movement of the major sectors over the last 5 days. All of the groups continue to be higher over their previous 5 trading days, led by discretionary up 2.75%. Energy seeing a bit of a rebound, but I do think that is counter trend in nature. We'll take a look at energy a little bit later in the show as well. Tech, we like to see tech near the top of the list because it is the largest weight in the S&P 500. Comms rounds out the group of top 4. Financials catching a little bit of a bid here as yields have started to back up. I will note, though, that the path of least resistance for yields, in our view, does remain lower. Industrials, real estate, and staples continue to be middle of the road. Materials, healthcare, and utilities, bottom of the list. Now, as yields back up, we would expect to see some profit taking in the utilities. We would expect to see some profit taking in real estate, or at least less relative outperformance in those groups. As well, we kind of want, if you're bullish, you want to see discretionary and tech outperforming the defensive areas of the market, such as real estate, staples, healthcare, and utilities. So far, that is the case. It is early days. We'll continue to monitor all of the trends in the market, not just the trends of the market. Our industry in focus today is one we've been bearish on, continue to be bearish on, is retail services. Over the past 6 months, this subsector has underperformed the S&P 500 by over 13%. Power bar ratio, which measures future potential, is weak. 22 bearish or very bearish stocks, 17 bullish or very bullish stocks, and it's currently ranked number 16 of 21 subsectors. So some of the names in that group that you want to avoid, potentially even look for bearish opportunities, would be National Vision, EYE, Monroe Muffler, MNRO, and Ollie's Bargain Outlet, OLLI. All 3 of those stocks have very bearish Chaikin Power Gauge ratings. And as we look at the group, XRT is the Spider S&P Retail ETF. We can see a bearish ETF Power Gauge rating. Bearish power bar ratio, 22.17, bears to bulls, and a weak trend as the fund trades below a declining long-term trend line. Now, you can see here, it's been an underperformer since last November. So market and model are in agreement. Same concept that we apply to stocks, we could apply to the different ETFs. We have a bearish rating, and the fund is underperforming. Persistently bearish Chaikin money flow, and an overbought reading on our overbought, oversold indicator. So to me, if you're looking for bearish opportunities within this market, XRT is an area of the market where it could provide some fertile hunting ground for bearish opportunities, especially if you drill down on these 22 names with bearish or very bearish Chaikin Power gauge ratings. Let's look at what's trending now. Friday's movers and shakers, our gainers and losers. Some M&A bids from private equity sends Semantic higher by 4.5%. Perigo getting the rights to Prevacid 24. That sent that stock higher by 3.66%. Alexion sees a bit of a rebound after some patent issues, up 3.5% on Friday. Tapestry, some thought that value investors could begin to come to the stock with a new CEO in place. Didn't see any real news on IFF to send that stock higher by nearly 3%. Loser side of the board, AMD bucking the trend of late in semiconductors, down 3% on the day. Monster down with the staples, down 2.7%. WEC caught a downgrade earlier in the week. I didn't see anything company specific on Friday to send that stock lower by 2.3%. FTI down 2% plus. No real news there. Same with XEC, down a little over 2%. Didn't see any real news to account for the trading in that stock on Friday. Let's take a look now. No breakout for the small caps. Now, we've talked about small caps for some time on a relative basis, and we'll continue to focus there. IWM relative to SPY, so Russell 2000 relative to S&P 500, clear downtrend. This chart should at this point be ingrained in your minds. It should be something that you could probably call to memory pretty quickly. We've talked about it a lot. Below a declining 200-day moving average in a clear downtrend since the June-July highs back in 2018. RSI of the ratio confirming the downtrend as it is solidly in bearish ranges. Notice how rally attempts do not get much above 60. That's that bearish momentum confirmation to the relative price trend. And at the same time, right, S&P 500 broke out of a trading range. S&P 500 is threatening highs from last fall. You cannot say the same for the IWM. The IWM, at best, on an absolute basis, continues in a trading range and has not come close to threatening its highs from back in the August-September timeframe of last year. Support 145, resistance 160. That continues to be the case. When you're thinking about looking for ideas within the equity market, for us, we think it makes sense to continue to favor large caps over small caps for equity exposure. And this chart tells that story perfectly. Yields back up, but the trend remains lower. Here's the 10-year yield, the CBOE 10-year U.S. Treasury yield index. Now, you see a bit of a backup here over the past couple of days as we've kind of tried to build a support area around the 1.5 mark for yields. Still below a precipitously declining 50-day moving average, below the declining 200-day moving average, and we do have a momentum confirmation. Again, look at how routinely the RSI for the yield becomes oversold, but rally attempts do not get it much above the 50 mark. Bearish momentum confirmation to the trend in yields, which is why we think it's likely to continue. Are we going to go down in a straight line? Absolutely not. I wouldn't be surprised to see some backing and filling here, especially if you look closely. There is a positive divergence at this most recent low. But again, I do think the path of least resistance for yields is lower. So as we back up, likely to see some profit taking in the bond proxies within the equity market, utilities, and real estate. But ultimately, I think the trends will reassert themselves, especially if yields continue to move lower. Energy remains a group to avoid. I said we would talk about it, so here it is. Here's XLE, the energy ETF on an absolute basis, and you can see below a declining 200-day moving average, below broken support, now acting as resistance. RSI sticking within bearish ranges. Notice that the RSI has not been able to become overbought on rally attempts, and we have 1, 2, 3, 4, 5 different times where it's become oversold. So that gives us, again, our momentum confirmation, and at the same time, on a relative basis, a clear downtrend. Energy clearly underperforming the broader equity market, so we want to continue to avoid that group or even look for bearish opportunities. If you do trade to the bearish side, you can look at a name like Chevron Corp, which I'm featuring in my note today. Chevron, CVX, very bearish rating, weak trend, weak industry group. underperforming the market, the intensity of that underperformance picking up as late, triggered an overbought sell signal today as our overbought oversold indicator moves to an overbought condition with bearish money flow. This is the setup that we look for if you're looking for bearish opportunities. You could take a look at a name like Chevron. So that's going to wrap it up for today. Head over to chaikinanalytics.com/today to sign up for that email. I hope you have a great start to the week. I will be back here tomorrow. Happy Monday, everyone.